This video was inspired by one of our subscribers who recently asked, what's our prediction for the 10-year bond yield? And it's actually a very important topic that we wanted to talk about. Now, we have an actual number for you, a prediction. We're going to talk about the 10-year Treasury bond. What's the current trend? Where's it going? And if we're right in our prediction, by the way, what will that mean? 10-year Treasury yield currently pays at 4.2%. We were above the 440 late November, just about a month ago. It's pulled back, but it's still, relatively speaking, quite high. What is the average historical yield? We took a lot of data. This goes back to the year 2000, 24 years of data. And what we want to show you is that broken down by month and day. The months are the x-axis across the top, and the days of the month, the y-axis on the left-hand side. And very simply, what we want to show you is what is, for example, December 10th today. The average yield every December 10th for the past 24 years is a 296. And we can see in just a moment, December actually historically has the lowest yields of the entire year. X-axis, those numbers 1 through 12, those are the months of the year. And over the past 24 years, the average yield for the 10-year U.S. Treasury is a 315. It's the lowest of the entire year. But this is really interesting. Notice the trend from January through May, and sharp increase in yield from 330 up to 338. And then in May, topping out, it begins to decline. Remember that old adage in the stock markets, sell in May and go away? Well, we know 10-year U.S. Treasury yields tend to move in the same direction as stocks. This is a really nice piece of confirmation that speaks exactly to that. Ultimately, the 10-year Treasury will move in line with economic expectations. Short-term maturity yields, they move in expectation of near-term interest rates. Long-term yields like the 10-year, they move in expectation of long-term economics. Now, with that said, we want to take a look at some of the big economic numbers, because ultimately, if we want to know where the 10-year yield is going, we want to know where the economy is going. In white, that's 10-year U.S. Treasury. In red, non-farm payroll. We just had a pretty good number. Notice in the circled areas, the spikes, the declining triple top on the 10-year Treasury coincides loosely with the best non-farm payroll numbers we've seen over the past year. Now, it's not an exact one-for-one correlation. Sometimes the market moves in expectation of good or bad numbers. But generally speaking, logically, good non-farm payroll number, good employment numbers, we tend to see expectation of stronger economies, and that coincides with higher yields. In red now, CPI, Consumer Price Index, on a year-over-year basis. That's our inflation rate. The declining triple top correlates loosely with a loose declining inflation rate that we've seen over the past year or so. It makes sense. Now, 10-year yields usually move with long-term economic expectations, but they also are sensitive to interest rates and the inflation rates. Also here in red, that's GDP, quarterly numbers. And we see the triple top, the declining triple top, coincides with a slowly declining GDP number as well. So the takeaway from this, again, if we want to know where the 10-year U.S. Treasury is going, we really need to ask ourselves this question: where do we think the economy is going? If, for example, we start to see really good GDP numbers, breaking new highs, the inflation rate maybe goes back up. Maybe not enough for the Fed to raise rates, but just enough to show us some real resilience in the inflation, sticky inflation, and the jobs are resilient. Well, that would certainly translate into 10-year. Conversely, if those numbers begin to decline, we could see weakness in the yields. Now, this is something different and really interesting. We're going to take a look at Fed funds, that's interest rates, minus the 10-year U.S. Treasury. This chart really tells the whole story. In blue, Fed funds, those are interest rates. In red, 10-year U.S. Treasury. The white area chart in the background, that's the difference between the two. Now, historically speaking, we usually see a negative, meaning that usually we see that the 10-year U.S. Treasury is above Fed funds. Fed funds minus Treasuries are in the negative region, except for these circled yellow areas, such as the year 2000, 2007, 2019, and then over the past couple of years as well. Those times, those moments in history are very important because those represent times that the interest rates are higher than the Treasury. Now, let's pause for a moment. This message is very important, what it's telling us now. The interest rates tell us obviously where we are right now. Now, I know the Fed's been cutting rates, but still, relatively speaking, we're pretty high. The 10-year US Treasury tells us the expectation of future economic conditions. And very simply, what this chart right now is telling us is that interest rates are more optimistic than the economy actually is. Otherwise, we would see 10-year Treasury higher than Fed funds. Notice 2000, 07, 2019, 24, 23, 24. Those pre-recession times, we don't know if a recession's coming, but in the past it was. Those pre-recessionary times were marked when the economy started to deteriorate faster than interest rates are coming down. Now let's take a look at the average Fed funds minus Treasury, 10-year Treasury. Normally, we know obviously the 10-year Treasury is above Fed funds, except for certain periods of time. The average difference between the two is a negative 1.44% yield. And again, we're taking 24 years of data. So right now, current Fed funds rate at a 450. The 24-year average is a negative 144. Here's our projection. If the math holds true, you subtract the 450 minus 144, it gives us a 306, roughly a 3% 10-year US Treasury yield. If history is any judge, that we see a regression to the mean, a return to the average, we would expect for the 10-year Treasury to come from the current 420, which is where we are right now, down to the 306 level. So the average, again, is the difference between the two. That's at 144, and you subtract that from the 450, which are current Fed funds rates, and that gives us a 306. Now, right now, again, we're at a 420 10-year yield. What will that mean if we go down to 306? Well, it means we're going to expect to see maybe softening GDP, softening inflation, not sticky inflation, maybe a little bit of a softening jobs market. It's not necessarily guarantee a bad thing. You know, if it's a soft landing, okay, that's fine. But we don't know if it's going to be a soft landing or a recession. That's left to be seen. But that's, if the math holds true, that's where we stand. Now, we just released yesterday our first installment of a brand new series called Economics 101. We take a look at wholesale inventories for our first installment. We want to take a very hard look at each one of our most significant economic numbers and really identify what role it plays within the economy and what it tells us. And the wholesale inventories, it's actually a very interesting data set. We hope this has been helpful. We look forward to seeing you back soon.